They waited until the very last moment. They waited until trading volumes were razor thin and most investors had already checked out for the holidays. They waited until the order books were practically empty. And then, on the final trading day of the year, they pulled the rug out from under everyone. If you're staring at your screen right now, you're witnessing a sea of blood-red numbers cascading across every precious metals position you hold. You're seeing silver trading at $70.50 per ounce. We've crashed down from the highs of $75 that we reached just 48 hours ago. We've given back every single gain from the past 2 days of trading. And for many investors who've been holding through this volatility, who've weathered the storms and believed in the breakout, this feels like nothing short of a complete betrayal. You held through the ups and downs. You believed in the technical breakout that seemed so promising. You trusted the fundamental story that made perfect sense. You stayed the course when others were selling in panic. You maintained your positions when financial media was spreading fear, uncertainty, and doubt. You ignored the noise and focused on the signal. And now, just hours before we ring in the new year, your portfolio is bleeding red ink across every single position you've carefully built over months and years of patient accumulation. But I'm here to tell you something absolutely crucial, something that could save your portfolio and your sanity in these final hours of 2025. What you're witnessing right now isn't a change in the underlying trend. This isn't a signal that silver is dead or that the bull market is over. This isn't a fundamental shift in supply and demand dynamics. This isn't industrial users suddenly finding massive new sources of supply. What we're seeing is a pure liquidity event. It's a desperate dash for cash by the world's largest banking institutions. And it's being driven by a specific bureaucratic regulation that forces these financial giants to dump assets and hoard US dollars on December 31st. This regulatory requirement isn't new. It happens every single year like clockwork. But most retail investors don't understand it, don't see it coming, and get caught completely off guard when it strikes. The banks count on this ignorance. They use your lack of understanding against you to shake you out of profitable positions at exactly the wrong moment. In this emergency market analysis, we're going to dissect this New Year's Eve massacre piece by piece. We're going to explain exactly why gold and silver are crashing in perfect synchronization. We're going to examine the Basel III regulations that mandate the systematic sell-off at year-end. We're going to look at the specific mechanics of how the global systemically important bank scoring system works and why it forces this behavior. And most importantly, we're going to explain why this crash is actually setting up the perfect launchpad for what traders call the January effect, a phenomenon that begins in less than 48 hours from now. The banks are cleaning their books right now. They're engaging in what's called window dressing, making their balance sheets look as clean and safe as possible for regulatory inspection. They're shaking the tree one final time before the calendar flips to a new year. But here's what they absolutely don't want you to know. This systematic manipulation creates an incredible opportunity for those who understand what's really happening behind the scenes. Understanding the mindset of institutional banking on December 31st is crucial for any serious precious metals investor. These aren't normal market participants making rational investment decisions based on fundamental analysis. These are massive bureaucratic institutions operating under strict regulatory constraints that force them to behave in predictable, mechanical ways at specific times of the year. The Basel III Accords were implemented after the 2008 financial crisis to prevent banks from taking excessive risks. The intention was good: create a system that forces banks to hold adequate capital reserves. But like most government regulations, the implementation created unintended consequences that smart investors can exploit. Every major bank in the United States must calculate their risk-weighted assets at year-end. This calculation determines how much capital they must hold in reserve for the following year. The more risky assets they hold, the more expensive their regulatory compliance becomes. We're talking about billions of dollars in additional capital requirements for banks that score poorly on these metrics. To understand why silver is dropping like a stone today, you have to get inside the mind of a banker on December 31st. Today isn't a normal trading day for these massive institutions. It's not about profit and loss or market trends or fundamental analysis. Today is purely an accounting day, and the stakes couldn't possibly be higher for these banks. At the stroke of midnight tonight, financial regulators will take a detailed snapshot of every major bank's balance sheet. This is not just routine paperwork or bureaucratic busywork. This snapshot determines their capital requirements for the entire next year. It determines what's called their Global Systemically Important Bank Score, or their G-SIB score for short. If a bank is holding too many volatile assets like silver, gold, commodities, stocks, or really anything other than cash, their risk score automatically goes up. And here's the devastating kicker for these banks. If their score goes up even slightly, they have to pay billions of dollars in extra capital reserves to the Federal Reserve. We're talking about massive financial penalties that can completely devastate a bank's profitability for 12 full months. These aren't small fees or minor adjustments. These are game-changing costs that can make or break a bank's entire annual performance. So what's the logical move for any rational banker facing this regulatory gun to their head? Sell everything. Dump the gold, dump the silver, dump the bonds, dump the stocks, and get to cold, hard cash as fast as humanly possible. Cash is literally the only asset class that actually lowers their risk score in the eyes of these regulators. Those massive red candles you're seeing on your chart right now aren't because Samsung suddenly stopped buying silver for their electronics manufacturing. They're not because the global shortage magically ended overnight. They're not because some new mine discovery flooded the market with supply. They're appearing because JP Morgan, Citibank, Bank of America, and every other major financial institution needs to show maximum cash holdings to the Federal Reserve tonight. To understand why silver is dropping like a stone today, you have to get inside the mind of a banker on December 31st. Today isn't a normal trading day for these massive institutions. It's not about profit and loss, or market trends, or fundamental analysis. Today is purely an accounting day, and the stakes couldn't possibly be higher for these banks. At the stroke of midnight tonight, financial regulators will take a detailed snapshot of every major bank's balance sheet. This is not just routine paperwork or bureaucratic busy work. This snapshot determines their capital requirements for the entire next year. It determines what's called their Global Systemically Important Bank Score, or their G-SIB score for short. If a bank is holding too many volatile assets like silver, gold, commodities, stocks, or really anything other than cash, their risk score automatically goes up. The G-SIB scoring system evaluates banks across multiple categories including size, interconnectedness, substitutability, complexity, and cross-jurisdictional activity. Each category carries different weightings, and the total score determines which regulatory bucket a bank falls into. The higher the score, the more stringent the capital requirements become. And here's the devastating kicker for these banks. If their score goes up even slightly, they have to pay billions of dollars in extra capital reserves to the Federal Reserve. We're talking about massive financial penalties that can completely devastate a bank's profitability for 12 full months. These are not small fees or minor adjustments. These are game-changing costs that can make or break a bank's entire annual performance. A single point increase in G-SIB score can cost a major bank $3 to $5 billion in additional capital requirements. So what's the logical move for any rational banker facing this regulatory gun to their head? Sell everything. Dump the gold, dump the silver, dump the bonds, dump the stocks, and get to cold, hard cash as fast as humanly possible. Cash is literally the only asset class that actually lowers their risk score in the eyes of these regulators. Cash carries a 0% risk weighting under Basel III calculations. Those massive red candles you're seeing on your chart right now aren't because Samsung suddenly stopped buying silver for their electronics manufacturing. They're not because the global shortage magically ended overnight. They're not because some new mine discovery flooded the market with supply. They're appearing because JP Morgan, Citibank, Bank of America, and every other major financial institution needs to show maximum cash holdings to the Federal Reserve tonight. They're dumping absolutely massive positions into an incredibly thin holiday market to dress their windows for regulatory inspection. This is purely mechanical selling. It's a regulatory flush that happens like clockwork every single year at this exact time. The beauty and the tragedy of it is how predictable it is once you understand the underlying mechanics. Veteran traders who understand this pattern position themselves accordingly every December. Because the market is so extraordinarily thin during this holiday period, their selling creates an outsized impact on price that would never happen during normal trading volumes. On a typical trading day, these same banks could sell these same positions with minimal price impact. But when daily trading volume drops to 20 or 30% of normal levels, every sale gets magnified exponentially. They sell 1,000 contracts, and the price drops 50 cents. They sell 5,000 contracts, and it drops $1.50. They sell 10,000 contracts, and it drops $2 full or more. They're artificially forcing the price down to raise the massive liquidity they desperately need for regulatory compliance. This is forced selling at its most pure and predictable form. But here's what changes absolutely everything about this scenario. Once that clock strikes midnight and we officially enter the new year, this Basel III rule no longer applies to their balance sheets. The regulatory snapshot is taken, the scores are calculated, and the pressure completely lifts like a massive weight being removed from the market. All that capital can flow right back into the precious metals markets as early as January 2nd. This is why seasoned traders often see what is called a V-shaped recovery in the first week of January. The pattern has repeated so many times, it's become almost mechanical. The banks sell everything on December 31st under regulatory pressure. Then they buy it all right back on January 2nd when the pressure disappears. You're watching the sell leg of this trade right now. The buy leg is coming on Friday morning when markets reopen. Let's examine what's happening in the gold market, because gold and silver move together more often than not, and today is absolutely no exception to that rule. Gold is currently trading at $2,064 per ounce. It's down $76 from yesterday's close. That represents a massive move for gold, which typically doesn't swing this violently in a single session outside of major crisis events. The gold market is significantly larger and more liquid than silver. So when gold moves this aggressively, it signals that massive institutional money is being forced out of precious metals across the board. This isn't retail investors panicking and selling small positions. This is institutional money being systematically liquidated under regulatory pressure. When gold sneezes, silver catches pneumonia. Because silver is a much smaller, more volatile market than gold, it amplifies every single move that gold makes by a factor of 2 to 4 times. If gold is down nearly 2% today, you can expect silver to be down 6, 7, or 8%. This correlation pattern confirms that what we're witnessing is a macro event affecting all precious metals simultaneously. This correlation also confirms that this isn't just about silver-specific supply issues. This isn't about industrial demand suddenly disappearing. This isn't about some silver-specific fundamental that changed overnight. This is fundamentally about the US dollar and what happens when massive institutions need to raise cash quickly under regulatory pressure. When banks sell assets for cash on this massive scale, the demand for US dollars spikes dramatically across global markets. The dollar index is rallying today, not because the American economy is suddenly strong, not because inflation is under control, not because employment data was fantastic, but because there's an acute shortage of dollars in the banking system to meet these year-end regulatory requirements. This dollar shortage creates what economists call a liquidity crunch. Banks around the world are competing for the same pool of dollars to meet their Basel III requirements. This competition drives up the value of the dollar relative to everything else, its basic supply and demand. When demand for dollars increases, while supply remains constant, the price of dollars rises. This dollar spike acts like a wrecking ball, smashing everything that's priced in dollars. Commodities get crushed, precious metals get destroyed, foreign currencies get demolished. Gold, silver, copper, oil, wheat, everything gets sold to raise dollars. But here's the critical point that most investors completely miss. A liquidity crisis is temporary by definition. These shortages are artificial and mechanical, not fundamental. The Federal Reserve knows exactly what's happening right now. They understand this is a regulatory-induced dollar shortage, not a genuine economic crisis. They will likely inject massive liquidity via the repo market tonight or tomorrow morning to stabilize the banking system. This is standard operating procedure during year-end liquidity crunches. When that fresh liquidity hits the market, the dollar will fall back down to more normal levels, and precious metals will snap back up just as quickly as they fell. We're currently sitting in the eye of this liquidity storm, but the storm will pass within days. The trading algorithms see the price dropping and automatically trigger more short positions. The computer programs don't understand Basel III regulations or year-end compliance requirements. They just see price momentum and react accordingly, pushing the price even lower toward the bottom of the trading range. This algorithmic selling creates what's called a cascade effect. Each wave of selling triggers the next wave in an accelerating downward spiral. High-frequency trading systems that execute millions of trades per second are particularly susceptible to this cascade effect. They're programmed to follow momentum, not to analyze regulatory causes of price movements. When they detect selling pressure, they automatically add to it, amplifying the original move far beyond what the fundamental cause would justify. This is the level we absolutely need to hold if we want to maintain any semblance of the bullish trend structure that's been building for months. If $70 holds firm, this entire crash becomes nothing more than a backtest of the previous breakout level. It becomes a painful but ultimately valid technical move where old resistance transforms into new support. Support and resistance levels in precious metals markets are particularly important because they represent psychological price points where large numbers of buyers and sellers make decisions. $70 represents a major psychological level. It's a round number that appears significant on charts, and it represents the approximate cost of production for many silver mining operations worldwide. If we can bounce from this $70 level with conviction and strong volume, it proves there's a floor of real buyers waiting to scoop up silver at these discounted prices. And when we examine the volume patterns during today's selling, we're actually seeing encouraging signs of absorption. Every time the price hits $70.50, buying volume spikes significantly. Someone is stepping in front of this freight train of selling. Someone is saying, I'll gladly take your silver at $70 per ounce. That someone represents what we call the smart money. Institutional investors, sovereign wealth funds, and ultra-high net worth individuals who understand the artificial nature of this crash and are positioning themselves for the inevitable recovery. Let's pivot to what the physical silver market is actually telling us, because this is where the rubber truly meets the road in precious metals investing. If you look at spot silver showing $70.50 on your computer screen, you might reasonably think you should be able to walk into any coin shop in America and buy an American Silver Eagle for around $74, right? Wrong. Dead wrong. This disconnect reveals everything you need to know about the artificial nature of this crash. I'm looking at dealer websites right now as we speak, and the premiums have actually expanded dramatically during this crash. Yesterday, when spot was higher at $75, premiums were sitting at around $10 over spot. Today, with spot down nearly $5, those premiums have jumped to $12, $13, $14, even $15 over spot price. Some dealers are charging $17 or $18 premiums for popular coins like American Silver Eagles. The physical dealers are absolutely refusing to lower their prices in line with this paper market crash. And there's a very logical business reason why. They know this crash is completely artificial. They understand this is purely a paper market event with zero connection to actual physical supply and demand fundamentals. These dealers have been in business for decades. They've seen this exact pattern play out every single December, and they know better than to get caught up in the regulatory manipulation. Think about it from their business perspective. If a dealer sells you a Silver Eagle for $74 today, and then the spot price snaps back to $78 on Friday when markets reopen for normal trading, they've just lost money on every single transaction. They can't replace that inventory at the lower cost, because this crash isn't reflecting real market conditions. They'd be selling real silver at artificial prices, which would be business suicide. So they're keeping their prices elevated, pricing in the real underlying value rather than this temporary liquidity-driven manipulation. This disconnect between paper prices and physical prices is one of your strongest signals that something artificial is happening in the derivatives markets. It's like the difference between the price of a stock on the exchange and what someone would actually pay you for shares if you tried to sell them privately. When spot drops but street prices stay elevated, it means physical supply remains extremely tight. It means there's zero panic selling happening in the real world where actual silver changes hands. Nobody's lining up outside coin shops trying to dump their silver stacks at these lower prices. The only people selling are leveraged traders staring at computer screens, forced out by margin calls and automatic stop-loss orders. You must trust the physical market over the paper market every single time. The physical market represents truth. The paper market represents manipulation and financial engineering. Physical silver is real wealth. Paper silver is just numbers on a computer screen that can be manipulated by algorithms and regulatory requirements. This industrial buying creates what traders call a hard floor under the silver market. The price can only drop so far before these massive industrial users step in and absorb all available supply. They have no choice but to buy silver. Their production lines depend on it. Solar panel manufacturers need silver to make solar cells. Electronics companies need silver for circuit boards and components. Military contractors need silver for advanced weapon systems and radar technology. The lower the price goes, the more aggressive their buying becomes. This creates a natural price floor that gets stronger as prices fall, not weaker. Now let's address the elephant in the room, the psychological and emotional impact of watching your portfolio bleed red ink across every position. It's completely natural to feel frustrated, angry, even betrayed when you see $75 yesterday and $70 today. The human brain is wired to feel losses more acutely than gains. But here's what you need to understand about market psychology and wealth building. You feel like you've lost money watching these numbers on your screen, but let me ask you this critical question. Did you sell yesterday at $75? No. Are you selling today at $70? I sincerely hope not. Then you haven't actually lost a single penny. You still own exactly the same number of ounces you owned before this crash started. The stock market, the commodities market, all financial markets are fundamentally wealth transfer mechanisms from the impatient to the patient. Today, the market is testing your patience in the most brutal way possible. It's trying to shake you out of your positions right before what could be a massive January rally. It's trying to get you to hand over your carefully accumulated silver position to those same banks who will need to buy everything back on Friday morning. Don't give them that satisfaction. Don't become another statistic in their wealth transfer game. I've been reading the comments across social media platforms, and I can see the fear and anger building in real time. It's rigged. They'll never let precious metals rise. The game is completely fixed against retail investors. This anger and frustration you're seeing everywhere, it's actually a powerful bullish signal for those who understand market psychology. It's what professional traders call capitulation, the moment when retail investors finally throw their hands up in the air and declare complete defeat. When optimism turns to pessimism overnight, when hope transforms into despair, That's usually marking the exact bottom of the move. The market has successfully washed out all the weak hands and fair weather investors. It's cleared out everyone who wasn't truly committed to the long-term story. Now it can begin to climb what we call the wall of worry. Remember this timeless market wisdom. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Today, we went straight back to pessimism mode. That means this bull market just got reborn with a clean slate. Let's look ahead to next week's Commitment of Traders report from the CFTC. It's going to show a massive reduction in the commercial short position held by the big banks. These same institutions causing today's crash are using this artificial selling to cover their short positions at extremely favorable prices. They're reducing their liability and their risk exposure at the expense of panicked retail investors. This positioning change is absolutely crucial because it means these banks will have much less incentive to suppress silver prices next week. With the commercial banks significantly less short than they've been in many months, the path of least resistance becomes upward rather than downward. The systematic suppression pressure has been vented through today's action. We also need to consider the global liquidity cycle that's been developing over the past few months. The central banks around the world are in coordinated easing mode. China has been cutting interest rates aggressively to stimulate their slowing economy. Europe has been cutting rates to combat economic weakness and deflationary pressures. Even the Federal Reserve has been signaling a more dovish stance recently, preparing markets for potential rate cuts in 2026. This coordinated global monetary easing creates what economists call a liquidity supercycle. When central banks around the world simultaneously create new money, that liquidity flows like water into every available asset class. Real estate prices rise, stock markets climb, commodities rally, and precious metals soar. This is not coincidence. It's the mathematical result of more money chasing the same amount of goods and assets. The global money supply is expanding at an accelerating rate. This newly created liquidity flows like water. It finds every crack, fills every gap, and eventually inflates the prices of all hard assets. Right now, this liquidity is temporarily flowing out of silver and precious metals because of the year-end regulatory squeeze we've been discussing. But in January, when the Basel III requirements reset and the regulatory pressure disappears, this tide turns dramatically. The global liquidity flows back into commodities, real estate, stocks, and especially precious metals. The global M2 money supply chart is literally the only chart that matters for long-term precious metals investors. And that chart is going straight up and to the right with no signs of slowing down. Silver will track this monetary expansion. It has absolutely no choice in the matter. Precious metals are the ultimate hedge against monetary debasement, and we're witnessing the greatest monetary debasement in human history. So as we prepare to close out 2025, I want you to remember the big picture that extends far beyond today's price action. You're holding a strategic asset in a world that's rapidly running out of critical resources. You're holding real money in a world increasingly dominated by fake digital currencies and endless money printing. The price dropped today, but the fundamental value did not change by even a penny. The value of silver is intrinsic. It's based on chemistry, physics, and thousands of years of monetary history. $70 is just a number flickering on a computer screen. The actual ounce of silver in your hand represents unchanging reality. We've reached the final chapter of this emergency market alert. We've dissected the regulatory flush that drove silver down to $70.50. We've analyzed the contagion effects spreading from bond markets and the panic selling by over-leveraged hedge funds. We've examined how physical dealers are holding the line on premiums despite this paper market chaos. Now you're left with a portfolio that might appear battered on your screen, but it's definitely not broken in reality. You're standing at the finish line of 2025. And what an absolutely historic year it's been. A year of major technical breakouts, a year of mainstream awakening to silver's investment potential, and it's ending with the ultimate test of your conviction as an investor. Tomorrow is New Year's Day. Financial markets are completely closed, computer trading systems are shut off, and bankers are nursing hangovers from their celebrations. It's a day of complete silence in the financial world. Use this silence to prepare yourself mentally for what's coming. Because on Friday morning, January 2nd, at exactly 8 a.m. Eastern Time, the opening bell rings and the legendary January effect officially begins. What should you expect when markets reopen? Based on the sheer violence and extremity of today's selling, the silver market is severely oversold by any technical measure. The rubber band has been stretched as far as it can possibly go to the downside. When fresh capital from pension funds, insurance companies, and institutional investors hits the market Friday morning, it's going to meet practically empty order books. The sellers have already sold everything they possibly can. They sold today under extreme regulatory pressure. They're completely gone from the market. So any new buyers will have to chase prices significantly higher to find willing sellers at these levels. I'm expecting to see a substantial gap up when markets open on Friday morning. We could easily open at $71 or $72 per ounce, erasing half of today's losses in the first hour of trading alone. This is what experienced traders call the slingshot effect. The same Basel III rule that forced prices down will allow them to snap back up with equal violence once the rule expires. For those interested in physical silver purchases, here's your optimal buying strategy. Silver is genuinely on sale today with spot prices down 8% from recent highs, but premiums remain stubbornly elevated because dealers understand this crash is artificial. The optimal physical buying window typically occurs about 24 to 48 hours after a major crash like this one. Dealers are currently paralyzed by fear and uncertainty, which explains why they hiked premiums as a defensive measure. By Friday or early next week, dealer sentiment will calm down substantially. They might lower premiums slightly to attract business during the traditional post-holiday buying season. If you can secure physical silver at $75 all-in cost while spot prices are recovering, that represents an absolute steal. You're buying an asset that was trading at $83 just 2 days ago. But let's lift our eyes to the much bigger horizon that extends into 2026 and beyond. This is the year when the mathematics of the global silver market finally reach their inevitable logical conclusion. We've systematically drained silver inventories worldwide for 5 consecutive years. We're now entering year 6 of massive structural deficits with no end in sight. Mathematically, this is the year when above-ground silver warehouses finally hit zero available inventory. When that happens, the entire price discovery mechanism changes fundamentally. It stops being driven by financial speculation and paper derivatives and starts being driven by pure physical scarcity in the real world. Scarcity pricing in commodities is exponential in nature. It doesn't increase by 10% or 20%. It increases by 100%, 200%, or even more until it completely destroys marginal demand. We could be looking at a year where silver touches $150 per ounce or higher. That might sound absolutely crazy today while staring at a blood-red chart. But remember that crude oil went from $40 to $120 in just 2 years during its last shortage cycle. Commodities move with shocking speed when true physical shortages develop. So here's my final verdict on this year-end massacre. It was a rigged game from start to finish, a systematic regulatory flush designed specifically to help major banks avoid billions in capital charges. It had absolutely nothing to do with silver's fundamental value and everything to do with the corrupt mechanics of our banking system. You survived this attack. You held the line when others panicked and sold. You proved you're what the industry calls a strong hand in this market. Now, enjoy your New Year celebration knowing you own the only financial asset that exists completely outside this manipulated system. You own the money of free people. You own the energy storage technology of the future. When the sun rises on 2026, the regulatory games reset, the artificial pressures disappear, and the silver market is finally ready to run toward its true value. You were early, you were absolutely right, and now you're perfectly positioned for what's coming next. Welcome to the year of the Great Silver Squeeze.